Imagine you're sitting in the gas line holding the wheel of a cranberry red 1970 Chevelle, and it's hot outside. Your skin is actually sticking to the leather, and your patience is waning because it's so hot, sitting in this gas line. And as your patience wears out, you start to think, how did we get to this point? In a post-World War II era, you'd seen 25 years of expansion. But we were not the only country that prospered. Luckily, we had other countries that we built up, and we actually spent countless resources helping our sworn enemies, Japan and Germany, get back on the world stage. And these countries were starting to not only compete, they were kicking our butt in some ways. And then inflation started to creep. Our goods started to get too expensive. The trade balance in the country went negative for the first time in the 1900s. And in a rash decision, President Nixon said, we're going to take us off the gold standard forever. But it was too late. Prices kept on increasing. And what inflation did is it started a decade of stagflation that found itself in every nook and cranny because oil was escalating so fast, prices of goods was escalating, and because they're very intertwined and oil's used in many goods, we saw prices increase 7% year over year. That made a huge difference in the families' budgets of here in America. Well, President Ford came to the rescue, or so he thought. He said, I am going to win against inflation. The American people are going to win against inflation. And you probably remember that acronym, Whip Inflation Now. Well, it sounded good. Everyone had the stickers, the buttons, but it didn't work out so well. Again, we lost to inflation for nearly a decade. The problem is my generation, your grandkids, your children don't remember a time of inflation. They don't remember a time of inflation because we've been spoiled. We've had very low, healthy inflation of averaging maybe 2%. And I'm really afraid for this generation because most of them don't know what a 1970 Chevelle even is. So, we find ourselves creeping up with inflation. Many of you have experienced triple-digit, double-digit inflation. As someone that's building a house, I've seen it where you're buying furniture and it's, again, increasing overnight. So what is that going to mean for your retirement? These are some of the questions we're going to try to answer tonight. Tonight's halftime report that we do every year is about looking back over the last 6 months since our State of the Market in January. And you probably will have a lot of questions tonight, and hopefully by the end of this presentation I answer some of them. But if you have a question, I encourage you with those notepads and pens to write it down, to make sure that if you have a question that you write it down, because if someone is thinking about it, they may not write it down. So if you write it down at the end of the presentation, we're going to answer those questions to the best of my abilities. Couple disclosures. I am not giving you financial advice. I'm giving financial advice to a big group of people. And that is always scary when you say an opinion because people can run with it. So again, all the attorneys in that 5 paragraphs basically just said that. So don't take it, again, for you. That's why we have reviews with you to say, hey, this doesn't apply to your situation, or it does and we do need to make a change. So what's on our agenda tonight? We're going to try to answer 4 questions. As you can see here, that we're going to start with how has the market performed over the last 6 months? Then we're going to unpack what is driving market performance by zooming into what's happened over the last 6 months. And then we're going to talk about where are we actually headed for the rest of 2021. And then the last is how at Swan Capital we've been preparing your portfolios for that next 6 months. So let's jump right in with how has the market performed. It's been a wild ride, as you can see. It started with January 20th, the inauguration of Joe Biden. And as everyone held their breath, I had many families come to us and say, Andrew, I am getting out of the stock market. And then I had many families come to us and say, when Trump was elected, I am getting out of the stock market. And I felt like the same echo. And you've probably heard me say this before, is that one president does not make an economy, at least in the short distance. So we saw that continue to go higher. The second is the American Rescue Plan, which is nearly $2 trillion of stimulus injected into the economy. The market keeps on creeping up. Then we saw the Suez Canal, a major artery, get blocked that really blocks the goods that go from the Middle East and Southeast Asia to Europe. And we already had so much supply chain logistics even before the Suez Canal got abruptly blocked by a tanker. And we had that issue because large national ports were closed up at half staff because, again, COVID restrictions. But the market kept on going higher. And then we're here where the pipeline, the last arrow, was hacked. And it's crazy to think that our infrastructure and major pipelines can be hacked by some teenagers living in their parents' basement. And when that happens, they ask for real money. 75 bitcoins or $4 million. And again, some of that was been able to get back to the people that they hacked. But again, it was another shock to gas prices that we saw. But what did the market do? It shrugged it off. It's been a wild ride to see over the last 6 months that regardless of whatever negative news comes, the market just shrugs it off. And it almost defies all laws of economics and finance. Or is it potentially we're not trying to accept what lies in the future ahead? Let's zoom in even further. If we zoom into the S&P 500, it's made up of major sectors. Everything from energy at the top, and then you have what? Online retail at the very bottom. And to make sense of this graph, the gray is what happened from 2019, November 2019, you can probably see it better than I because I have my back to it, to, again, as you can see, November of 2020. 2019 to 2020. And you can see what sectors did really poorly during COVID. Obviously, you're going to see situations like travel, cruise lines really struggled during those periods, that first year back. But then you can see the ones from November 20 and 20 that has continued. And leading the pack, as you see, energy is leading the pack. And I am so thankful that for about 5% across all of our portfolios, we bought VDE, Vanguard Energy. So we bought a small stake when energy was actually doing really poorly last year, and we were able to ride that up for a 50 to 100% return for a small bit of everybody's portfolio. So that was a great move. But we're keeping our eye on these sectors because, again, their performance doesn't mean that's going to continue going forward, obviously, till the rest of 2021. We also want to look abroad and look at the geography. Some countries did not recover as quickly as others. If you look at the big gray, you saw China. Again, where COVID originated, they did well in 2020 by recovering very strongly. And then they've got off to a really slow start because, again, the government's slowing down the Chinese tech sector. And then you see Europe, which had a really slow time with COVID restrictions, and they were really hit and battled really hard with COVID, and they're just now making a really good resurgence in their market. But again, we'll wait to see what happens. Variants will affect that. You can see the United States, that V-shaped recovery really quickly in March of 2020 and on. It came out of that pretty strongly, and we really no end in sight how well our performance has been in green. Emerging markets also staged a really good comeback in 2020 as well as 2021. So moving on, I want to talk about the forecast that we talked about in January at the State of the Market. I showed you this. I said after the black swan event of COVID-19, the analysts believe that we're going to have a strong year out of the trough because it's really nowhere up but north. And we also knew that the market was getting injected with all the stimulus, so many of the analysts had a really good estimate. They said that the market would end the year, as you can see, the group average, and these are some of the smartest minds that the world can have in finance, at 4,300. But look at where we are today. In green, we're almost at 4,500. So that's the entire year of 2020 was forecasted by the analysts, and we did it in 6 months. Not a bad year in 6 months. But again, these are predictions, best guesses. You've been here when we had other state of the markets when the experts said the market is going to go up, and then COVID-19, other events had derailed those estimates completely. Again, at the end of the day, these are just predictions. These are just estimates. But we do want to keep our eye on that because Wall Street as a collective whole believes that we're going to finish the year very strong. What can derail it? Two things we have to keep our eye on. First, increased restrictions from COVID from various variants would definitely throw another curveball, and we're already seeing potential lockdowns in certain areas. The second is a market retreat evaluations, and I want to show you two tools that we use to evaluate if the market is overvalued. So behind me is the S&P 500 Shiller PE ratio. So what it does is it tracks basically $1 of earnings compared to that stock market value. So for $1 of earnings, if you were going to buy a company, usually buy that company based on its earnings. And again, the S&P 500 is made up of 500 large U.S. companies. And as you can see behind me, in the roaring 20s, we saw that it peaked out at 30 times earnings. Which means if you were going to buy $1 million business back then, it would cost you $30 million to buy $1 million business. Well, that didn't last long. That peak turned into the Great Depression that you see, that steep decline. Fast forward, one of the longest periods that we've stayed with a high PE ratio is the 1990s. The 90s were, again, a great period of expansion, and you saw the dot-com crash ended very badly. As you can see, it went as high as 45. 2008, right after it, that second hump, again around 28, 30, and then we had a huge increase to where we are today. Today, the American people are willing to pay $38 for $1 of earnings. And that's just the average. If you look at Tesla, which is now a part of the S&P 500, it's selling at 650 times earnings. That means, would you pay $650 million for a company that only makes $1 million? So a lot of people say, well, Andrew, the market just keeps on going up. That's true, and it could keep on going. As we saw in the 90s, that lasted. But we here at Swan Capital do believe that we are in a bubble. And we can't necessarily put our finger on when that bubble will pop, but the day is coming. And I want to talk about how we've prepared the portfolios to continue to grow, and we've prepared for them to pop. Another indicator, which I like to look at from time to time, is the Buffett indicator. Again, these are all various perspectives. The Buffett indicator, obviously made famous by somebody from the Midwestern region that you've heard of. He initially endorsed this one, but he says it's just a rule of thumb. What it compares is GDP, the gross domestic product of the United States, how much power that we're how powerful our economy is on a yearly basis, our GDP, compared to the size of the stock market. And as you can see, we're 90% above the historical trend line. Again, unprecedented. Now, I want to use a little grain of salt, though, and make sure that you understand that we're in a low interest rate environment, and that's where many people say, well, the market's overvalued, but it's not, this time is different. They keep on saying this time is different because there's some things that we haven't even seen in economics textbooks, like negative interest rates and low interest rate environment like we're living in right now. So again, the economics textbook is thrown out the window. Warren Buffett, Charlie Munger, again, who gets credited for this Buffett indicator, even he says, I read one textbook I could find that talks about negative interest rates. So This does show us, though, regardless of what people say, this time is different. We are in overvalued territory. So it's not if we will see a bubble, it's how soon we will see that bubble pull back. So what is driving this market performance? I get that question all the time. What's continuing to drive it? I know what you're saying, that the market's overvalued, but why does it keep on happening? The market is made up of multiple. It is a very complicated mechanism, and these are just 20 major indicators. As you can see, it has the yield curve that has to do with interest rates and bond interest rates. You have monetary policy with the Fed. You have fiscal policy. So many things to look at. And in January 2021, when we had the state of the market, I told you we had tensions in the United States about the inauguration. We had equity market valuations were high, but people were still concerned about the yield curve. They were concerned about energy costs. But fast forward to now, there is some euphoria again that we're saying in the market. You can see that everyone's pedal to the metal because of monetary policy that's at full speed, fiscal policy that's at full speed, interest rates. Those are all very interconnected. And so obviously consumer sentiment with a lot of stimulus and everyone having cheap money out there, of course consumers are very excited about spending, especially when we're a consumeristic country. We still have plenty of geopolitical issues. We have political environments, Harry. I mean, if you don't think so, just at your next dinner party say, here's my opinion on masks and vaccines. That'll go over real well. So it's pretty tense, and this is not the only country it is tense. It's tense in other countries, so those are still yellow. I don't know if we'll ever get to sing Kumbaya together, but we all, because that's been yellow for a long, long time, but at least it's not red. My underlying concern, though, is that if as a country we continually make money easy to get, it makes consumers get used to a very short recession periods. And we've been spoiled with 2008 was a very tough recession, but it recovered quickly because the Fed intervened. We had the V-shaped recovery that only lasted a quarter or two with COVID. That is not normal. If you look at the Japanese Nikkei, it took 20 years. The Great Depression took 10 years. It can last a lot longer than 2 quarters. That takes us to the Fed and their intervention of low interest rates. They want and continue to believe that we should keep interest rates low till 2023, and they've already revised that a little bit. And they're trying to keep interest rates and inflations to at least inflation to 2%. That's their target. So they're kind of manipulating interest rates to get that to that period of time. The issue, though, is that they're believing that inflation is transitory. It's temporary, which we'll talk about in a second. But interest rates are huge when it comes to liquidity in the markets. And just one thing you're seeing is in the housing market, obviously. With interest rates being low, people have no problem with a smile on their face overpaying for a house because cash is cheap. But again, that burdens the federal government, it burdens banks to take that debt on for 30 years at a very low interest rate. And again, when interest rates finally do turn the corner, it could spell a lack of enthusiasm for the stock market. Because think about it, if interest rates are 1 to 2% on a treasury bond, that's not really exciting to lock your money up for 10 to 30 years at 1 to 2%. So what do people do? They say, well, I'll step over here to the stock market. That's 8 to 12% return. And they negate the thinking of, what about risk? We're taking exorbitant amount of risk to get that 8 to 12%. But again, it keeps on going up. And that fuels the belief that I've made the right decision. GDP growth. Gross domestic product. As you can see, we had a huge hole that we found ourselves in the first quarter of 2020. You can see it dropped about 5% because of March, but then the huge drop that we saw, 30+%. And we've been crawling out of that hole ever since. And ever since, GDP has been growing up nearly every quarter, which is nice to see. But it takes a while to get yourself out of 30% drop in GDP. Just because you make 30% on the back end doesn't mean that you're back to even. And again, you're seeing that already slow down dramatically. And one reason you're seeing that slow down is because the stock market has already priced in all the restrictions being lifted. And you can see all of the greens where restrictions have been lessened or completely done away with, right here in Florida, like as you can see. But if we see variance in another curve of lockdowns, the cruise lines, travel industry is going to take that on the chin because they've already priced it in that everything's going to go back to normal. And that is one of the biggest concerns that I can see for some of those industries and those sectors. The other thing that we're seeing in the market is FOMO, fear of missing out. And that's called that's the new age word, but the old age word is called speculation. You're seeing companies invest in AMC and other companies that when I go attend a movie, it's just me and Natasha. I think we've like rented the movie theater for ourselves. And in long-term growth of those companies, again, it's exciting because you're seeing triple-digit returns, but you're buying into a company that no one is there. And that is a very scary thing to invest in. And so my word of caution to you, if you're investing in meme stocks, very volatile stocks, or you're investing in cryptocurrencies, or if you have a friend that's investing in those, you have to ask yourself 3 very important questions. 1, do I understand what I'm investing in? Can I explain to you why it goes up and why it goes down? Either every day or every 6 weeks, tell me why that trend's happening. And lastly, do you know the CEO's name of the company you're even investing in? If you don't know who AMC's CEO is, you're probably not doing your homework. And there's no difference than speculation at Biloxi. At least Biloxi, you might have a free drink with it, which is nice. So fear of missing out is a concern. Now, you also have to keep your mind on the snowball effect. Because a lot of people say, Andrew, I understand what you're saying, but I'm going to be the second to last musical chair. I'm going to get in there, and before it drops, I'll get out. The unfortunate thing is the snowball effect takes people away with it, and the greed kicks in, and then people do lose significant money. And that is a sign that we are in a bubble. When you see market speculation, when you see the market is overvalued, and people say the words, this time is different, it's not a good recipe. So, what lies ahead? As you can see, the GDP, we talked about the GDP, the hole that we've been crawling out of. Well, behind that GDP climb of 30+%, we didn't do that with our own hard work. We did that by pumping trillions of dollars. 2 administrations have pumped trillions of dollars into the economy. And the issue is, as you can see, unprecedented relation between GDP, what we're actually producing, and how in debt we are. And that is highly alarming. And I think the title of this PowerPoint is where we need to just remember is behind a large stimulus hides a large debt. And so for just a second, I want to play you a really good personification of the United States for a second.
I'm Stanley Johnson. I've got a great family. I've got a 4-bedroom house and a great community. Like my car? It's new. I even belong to the local golf club. How do I do it? I'm in debt up to my eyeballs. I can barely pay my finance charges. Somebody help me.
Need a smart way to consolidate your debt? At LendingTree.com, banks compete and you choose the loan that's right for you.
And again, if we're not careful, we'll think that we climbed out of this hole all by ourselves. And unfortunately, what we've really done is just saddled future generations and the generation for the next foreseeable future with a debt they can't pay back. The average American, a newborn baby today, is in debt to their eyeballs when they come out of the womb at a rate of $85,000 per U.S. citizen. I told Natasha while I was working on this, I said, hey, I didn't know if you know, but you got $85,000 of debt you never heard of. She said, excuse me? And I said, yes, we're all in debt for what policymakers have decided to do. And that's a real issue because when it starts, those finance charges start to creep in on our national budget, it can spell disaster. So let's continue. Inflation, the secret tax. I hope we do not find ourselves again in some sort of gas line, in another decade of stagflation. But we have already seen inflation creep well above their 2% target there at the Fed. 5.4% is what the Consumer Price Index is saying that we're at. And I can tell you, many of you have already experienced triple digits, double digits. I have a friend that's in air conditioning, and he sells very large air conditioning, and he says we've seen prices go up double digits in the AC industry. And again, you take anything. If we're talking to maybe someone that works in pipelines and selling PVC pipes, that gets passed down to the end consumer at the end of the day. And that is a really scary situation to see that double-digit inflation could get passed down. And the canary in the coal mine that we all, unfortunately, are not talking about is look at Social Security. That's potentially going to have an increase of 6%. If Social Security is giving you a raise of 6%, I would be very concerned, because that means inflation is worse than the government even wants to say. Job market. I'm sure many of you have heard about the signs and seen the signs and wondered why places are closing early. And it's because there's this shift of people that want to work from home. They want that work-home lifestyle balance. And then you're seeing, again, many workers that are not coming back fully because stimulus is available. Now, I will say that it looks positive at first. Again, the job recovery is coming back. But if you talk to fellow local employers, it is hard to find talent that is ready to work and is qualified to work. So it's something we're keeping our eyes closely on. So, what strategies at Swan Capital have we implemented to protect you from some of those risks? And what are we working to do to protect us over the next 6 months? So some of the things that I want to talk about is first talk about our portfolios. You know that we have 4 portfolios. We have our dividend portfolio, our balanced portfolio, our growth, and then our aggressive. These are unique portfolios that are distinct based on their risk and return and their objectives. So we'll start off with the dividend portfolio. Really happy to see the dividend portfolio push out 2 to 3% in dividends. That's its goal, is to accrue dividends in a very diversified fashion. Now you can see that we're using everything from preferred shares of companies, we're using real estate, we're using bonds, we're using dividend paying stock to generate that. We're trying to do it in the most diversified fashion. The next portfolio is our Swan Balanced portfolio. Over the last, from 2005 track to presently, what's really special about the Swan Balanced is that it's kept pace with the S&P 500, which is very difficult to do. But the difference is it's got 40% of bonds. Now, you've probably noticed that we've been shifting to low duration bonds because if interest rates start to rise, we want to be positioned to reduce that exposure and not be stuck in long-term bonds. As you can see, we have a lot of diversification from large company stock to small, mid, real estate, international, very well diversified in the Swan Balanced portfolio. Growth has a huge reduction of bonds. It only has a little bit, and it's outpaced the S&P 500, which again is very difficult to do. See, with Swan Balance and Swan Dividend, our goal is to try to get as close as we can to the S&P 500, but reduce the risk when there's major pullbacks. But Swan Growth, again, has a little bit of real estate, large cap, medium size. It is very diversified. And then last is Swan Aggressive. That's going to be swinging for the fences. There's no bonds in there. Again, very diversified, and we've seen that actually since 2005 beat the Russell 2000, which again is not easy to do. So the other thing that we employ when we build each and every one of your financial plans is something you're familiar with, and that is a solid fiscal house. See, we want a percentage in all of these areas. We want a strong foundation where your emergency fund exists. Because when a major pullback in the market happens, for families that are 100% dependent on the stock market, they have to take all of their vacations and put it on pause. Then we have wall accounts that when the market zigs, they zag. And then we want roof accounts. Even if we do despise and don't trust the stock market and it scares us, we want a little bit, typically in the stock market, because it keeps pace with inflation for the long haul. By building a solid fiscal house, what we're doing is preparing for all seasons, not just spring. This is a very interesting chart. It shows you the performance of various asset classes over the last 10 years. You can see that large company stock has been like Alabama football. They have had a long, strong decade. For an Alabama fan, Roll Tide, right? And there's not as many Roll Tide fans, I guess, in here. They're not as brave, but they should be. So with the alternative investments, you can see that large cap has done really well, but historically, small company stock has done well over the last 20 years. So that's why we have a diversification to small and mid cap. And again, we may give up points by not having a huge percentage in large cap in the short run, but in the long run of retirement, because again, retirement is a marathon. It's harder to plan when it's a marathon. You have to have more diversification than just large cap stock. But on the opposite sides, we have commodities. You can see how bad bonds have performed in better times. Again, this is the bull run for bonds. It's not going to get much better because over the last 30 years, what have interest rates done? They've gone down, but that's helped bond prices. But I want to zoom in here, because many of you heard that I need to have a mix, Andrew, in my 401k of a good bit of bonds and a good bit of stocks. We call that a 60-40 split. And again, it's very similar to our Swan Balance portfolio. Because we're at market time highs, we've had a lot of clients in Swan Balanced, but we also want to have a wall account, which takes us to why we have a wall account. Now, a wall account can be anything like, I'm trying to go backwards, but that's not working well. There we go. So a wall account can be things like index CDs. That can be puts and options. That can be private equity in a small business. That could be indexed annuities. What you can see, it's really fascinating, is the 60-40 split is earned a 7.8% return over the last 10 years, but a wall account, like an index annuity, for example, mixed with stocks, is done 9.8. And the difference is the wall account has safety of principal while the bonds don't, because you can see bonds lose money right here. So, fascinating chart. The other thing that we're doing is if national debt continues to escalate and they look to the American people and saying, hey, we've climbed out of this hole thanks to printing money, but we're expecting you to pay for it. We have to have a plan for increased taxes. And that's why you've heard me talk about the tax clock before, that all money is not created equally, and that I highly encourage that you tell your kids, your grandchildren, to not put all their money into a 401k, to put it into a Roth 401k, a Roth IRA, so that they're diversified tax-wise, not just their investments being diversified, but your taxes being diversified. And so that's why you've seen a lot of us talk about diversification in taxes lately. The media is finally catching up and saying, should you have a Roth IRA? You can even see headlines where the billionaire Peter Thiel has a Roth IRA. Should you? Again, you know that for the last few years, we've been ahead of that curve, moving many of your accounts from IRAs to Roth IRAs because we wanted to shift to tax-free investments. In case they turn to us and say, I want you, the people with money, to pay for the tax bill because we've bailed everyone out. And that's why we continually head from qualified to tax-free investments. So what's coming next? The completion of the in-house rebalancing of all of our portfolios. We used to outsource that to AE Wealth Management, and we're now finally in the home stretch of switching that over. And we did that because many times families would say, who is AE Wealth Management? And they're a great company that we hired out of Topeka to rebalance our clients' portfolios. But now we're internally handling that. That's why you've seen some new faces lately like Lucas and others that help you make one that all integrated into Swan Capital, which is what I've always hoped for, is that we didn't outsource that. So that's that major change. You can see that list of what's coming is short because that took a lot of work. And so you should see all that coming to completion shortly. Steps for you to take. What can you walk away asking yourself, what can we do? The first thing is keep us up to date with life changes. Because if your income needs change in retirement, I would love to hear about that. I'd love to hear about how you're planning on taking more vacations because these restrictions are lifting. And we need to spend this money because, again, we can't take it with us. You've heard me say that many, many times. The other thing that we want to be aware of is any cash that's sitting on the sidelines. Some of the investors that are going to get squeezed the most are investors that are only making 0.4%, 1%. If inflation's 5.4% on the basket of goods according to the CPI, the Consumer Price Index, and we're making 1%, then we're treading water or going below. And we don't want to do that. We don't want to be on a treadmill watching everything get more expensive, but our money not keeping pace with inflation. And lastly, is just tightening up. This is a good time to make sure that you have your legal documents done, to make sure you have payable on death on all your bank accounts, to review your legal documents. So that's the steps that you can take. I think we have time for maybe 3 or 4 questions. I know everyone's saying, get off the stage. Jungle Cruise is coming. The movie Jungle Cruise. It's hard to compete with The Rock. So do you have anyone have some questions that burning questions that they want to ask? Go ahead.
You know, we all are a little bit older. We've all remembered times when we had...
Speak for yourself, Mr. Roque. No one's older here.
No, we all remember times of 8% return, 10% return, and I guess we looked like, you know, in the future, like, oh, when my money's building that, and now we're really way down in the dumps, and like you said, inflation's spiking up, and should we be looking at some higher returns in risky areas like cryptos?
So that's a great question. So he's asking is if inflation's as getting higher and higher, how do we combat that? Because we're going to need to make more return. If we're making 10, 12% return, but inflation's 5%, do we need to be investing in cryptocurrency, volatile stocks? So my quick answer is no, because market evaluations are just so high. Now, I think there is a time and place to increase our risk. And that is one of the things that we've talked about, and I've talked to you individually in the reviews, that when we do see some pullback, like again a March 2020, we were able to move 20 to 30% of your portfolios from swan balance to swan growth. And again, that was a V-shaped recovery. That we went quickly out of that hill. If we get another chance, we're going to move even more over to more swan growth and swan aggressive, because we want to run into the storm, but again, we don't want to just run with the storm. So I think it's too early to take more risk personally. So that's my short answer to that one. Thank you. Rob, go ahead with another question. No questions. No. That Chevelle could be an SS. That would be so nice. I was daydreaming earlier about that. I said I could use a Chevelle. All right. If we will stop the streaming